This is my debt so far accrued, not including my potential mortgage. Now, when you go to buy a home, they're going to factor in the house that you're looking to finance into your debt to income to see if it fits on this side of the pyramid, right? Okay, so welcome back, you guys. It's the Game Changer, and today I'm here for a very important video. When I started this YouTube about 2 years ago, I made a decision that it wasn't just going to be about cutting hair, or because I'm not a hair cutter. Barbering is more than just what you can do to a head. It's a lifestyle that you want to live, because a lot of you guys, younger barbers, cool, or just even older barbers, you want to grow this lifestyle, how to financially plan, how to financially grow, how to buy a home, how to establish credit. So I believe, through my journey of learning this, I want to share with you guys as well, because I created this channel to further knowledge, to help grow the things that you know financially, behind the chair, barber etiquette, through the business, marketing. So that's what this is about. This page is more than, the Game Changer is about changing lifestyle. The Game Changing lifestyle, not just through my opinion. Hold on. So with that being said, today's video is about debt to income ratio, how it affects the house buying process, or any process when it comes to getting lenders or getting a loan. Debt to income is very important, especially in the housing process, especially in any kind of big endeavor, because a lender. So today, let's start like this. We're gonna have key terms. One of the key terms is gonna be lender, gross income, consumer, debt. These are terms I'm going to be using that I want you guys to know what it means, because there's nothing worse than someone explaining something that you can't understand because you don't know the terminology. So we're going to actually work on that as we go along. So what is debt to income, and why is it so important? Why is it so important? This will be one of the very many videos through my journey of teaching how to grow the financial side of this lifestyle, entrepreneurship. Because I'm in the process of buying a house right now, so a lot of this stuff I would have loved to learn from someone. Took a lot of research, took time, trial, error, mistakes. So I'll be still got the tax video coming, debt to income ratio, how to raise your credit score, what is credit utilization. These are all things that are very, very important that I'll be touching bases on. So what is debt to income ratio? Debt to income ratio is the percentage of consumers' gross monthly income that goes towards paying their debts. It's the percentage of gross monthly income that goes towards paying their debts, okay? So, what is gross monthly income? What is this word gross? We know what monthly income is, how much money you make monthly. What is gross monthly income, and what is debt? Because usually when we hear the term debt, it's such a negative word. You in debt, you in debt, you in debt. Well, debt is not always negative, but we're starting with gross. Gross monthly income is the amount of income you make before taxes. Wholesome. Your gross amount. What do you make gross? You have a pre-tax income, which is gross, and you have a post-tax income. That's what gross income is. So when they use your debt to income ratio, they're basically they're going to start with your gross income. Look at the percent of your gross income that's used to pay debt, okay? What is debt? So debt is there's good debt and bad debt. Bad debt is when you had a light bill at your previous apartment, you had a final balance when it was all said and done, you didn't pay it, they sent it to a collection company. Now that's a small debt, that's a negative debt, that's a negative account, that's collection, that's a collectible account. All right, now what is good debt? Good debt is a car, because you took out a loan. Basically, you're in debt when you owe someone money, right? I owe you, if you want to say, you didn't have the cash to buy your new car, so you went to the bank, took out a loan, you're in debt. Positive debt as long as you pay it on time. Whenever you take out a mortgage loan, that's also great debt as long as you pay it. So sometimes debt can really help you as long as you're not over your head, okay? So again, what is debt to income ratio? It's the percent of a consumer's monthly income that goes towards paying their debts. Who's the consumer? You're a consumer. Whenever you're buying something, you're consuming. What do you do when you eat? You consume the food, right? A lender is someone who lets you borrow the money. Lenders lend to the consumer. Consumer, who is the purchaser. If you're buying, you're a consumer. So that's pretty much debt. Debt, when you owe someone. Consumer, the person who's buying. Gross, the whole. Okay? To break down debt to income ratio, because we're going to get into, we got front end and back end ratios. But so, okay, Devontae, I get it. You said debt to income ratio is a percentage of my monthly income that goes towards paying my debts. Yes. Now, not everything is calculated into debt to income ratio. Literally, there's only a few, and we'll break down the types of debts that are accounted in your debt to income ratio. But so whenever I need to go buy something or borrow money, usually bigger purchases, sometimes car, but usually, well, always house, right? They need to know my debt to income ratio. They need to feel comfortable letting me borrow this big lump sum of money, so they want to know what's on my plate versus what I'm bringing in, right? Because if my plate is too full, they won't give me this big loan to put more on my plate. So essentially, when you're buying a home to get a mortgage and your house is $100,000, minus what you're putting down up front, you're looking to borrow a large lump sum. They're gonna let you borrow $75,000 or $80,000. So if your debt to income ratio, if your plate is already full, why give you more? Okay? So I'll give you, during the video, I'll give you an example. I got some figures drawn up of, so we can look at this front end so you can see what I mean more. So we can break down how debt to income ratio is actually calculated, what's taken. All right, so next, let's talk about front end ratio. What is front end ratio? Front end ratio is the percentage of debt that goes straight to the house. Example, mortgage principal. Mortgage principal. What is a mortgage principal? Mortgage principal is the part of your monthly loan or the part of your mortgage that goes strictly towards the house, right? That's part of your front end ratio. Your insurance, your mortgage insurance, that's part of your front end ratio. Anything that goes strictly towards the house. The part of your mortgage that goes towards your interest rate. Anything that has to do with the house, that's the front end ratio, right? Some lenders, they break down their DTI in two sections. They'll take your front end ratio and your back end ratio. They may say that your house, your household expenses, PMI, mortgage principal, mortgage insurance, which is PMI, taxes, HOA fees, any more than 21% for you to get approved for this loan, for this house, okay? That's front end ratio. Front end ratio is the percent that goes strictly towards the house. So your mortgage loan, basically.